So, what are some common challenges that you've seen in the mortgage industry, and how have you addressed them?
What you perceive the market rents to be as the consumer, they're not necessarily what the appraiser thinks. Right?
So, what would you say specifically for Philly investors? When does it make sense to use DSCR loan versus regular conventional? So, you're saying that DSCR existed pre-2008 crisis, and
correct. In some shape or form, maybe not in these exact guidelines, or definitely not.
We're here to share insights and experiences, not legal or accounting advice. Be sure to talk to your attorney, accountant, or professional advisor before making any decisions. Everyone's situation is different. Get the help that is right for you. Welcome to another episode of the Philly Landlord Guy. I'm your host, Yuri Skripnichenko, the guy with impossible last name. Just think of me as the Philly Landlord Guy. I am a licensed real estate broker and certified property manager in the city of Philadelphia. So today we're diving into a topic that every real estate investor needs to know and understand. We will be talking about difference between DSCR loans and conventional loans, and which one makes most sense for you to use for your Philly deals. Joining me is Leon Belov, a seasoned mortgage loan officer with a lot of lifetime experience. He helped countless investors get in financing for their deals in real life. You might have seen him on his YouTube channel where he breaks down complex lending concepts for real estate investors and people who are looking to buy real estate. Now, without further ado, let's welcome Leon and get right into it. Hi, Leon. Thank you for joining us today on this episode. And to begin with, can you tell us a little bit about yourself?
Hey, Yuri. Always a pleasure seeing you. It's been a while since we last sat down like this. I'm Leon. I operate the lending group, which is a local mortgage lender in Southampton, Pennsylvania. I'm a loan officer. I'm an owner, a lender, all of the above, right? So I help people obviously purchase and refinance real estate, primarily in the New Jersey, Philadelphia, Pennsylvania market. Try to keep it as local as we can. Anyone that needs to buy, anyone that needs to refinance, anyone that needs advice, whether it's, today we're going to talk about DSCR. So if you're an investor, we welcome pretty much everyone, at least with questions.
Okay. So how did you get into it? How did you get into mortgage industry, and why did you decide to become a loan officer?
It was just the thing to do. I've been doing this since 2002, 22 years of my life. Just needed a job at one point in life, and, this was it, and, kind of dove in and never looked back. So it's just something that, I don't want to say it came naturally to me. It's I'm always running, always trying the next deal, trying to help the next customer. It's always keeps you on your toes is the answer, but I like it.
Yeah, it's kind of like property management. It's you never grow up dreaming about being a property manager, but once you start doing it, you like it and you just keep going.
Exactly. Yeah, there was no formula. Oh, I want to be a loan officer. Oh, I want to do loans. It's just something I fell into and never really fell out of.
Okay, so I know that you've been doing it for quite a while. I think from 2002?
Yeah, 2002, exactly.
Okay. How has been your experience since 2002, and how did it shape your approach helping clients in Philadelphia market with loan products?
Sure. Well, I think mortgages in general have really evolved since then. I mean, there was a major shift in right around 2009, 2010 in loan products and mortgage products. And I feel that now we're only coming back to what we had pre-2008. Obviously there was a major crash in the real estate market. Not so much the local market, but definitely there was a major shift. But all of these products that we now call DSCR, non-QM falls also under that umbrella. That was all around prior to 2008, and way more. I want to say you had way more options back then, and now I'm seeing it come back again, and it's coming back and growing year over year.
So you're saying that DSCR existed pre-2008 crisis, and
in some shape or form, maybe not in these exact guidelines, or definitely not under this name. Because when I first heard the term DSCR, I had to take a pause and understand what it means. It stands for debt service coverage ratio, is what it means. Basically, the gist of DSCR is that the investor or the bank, the lender, whatever you want to call us, we're looking for you, the investor, the home owner, property owner, we're looking for you to be able to cover your monthly mortgage payment, which includes principal, interest, taxes, and insurance, and any homeowner association or HOA that would apply. We want that to be covered by the market rent. That's the basis of DSCR. So if we can do that throughout the underwriting process, you're pretty much approved.
Okay, so basically what you're telling me, if I buy a rental property that, let's say, just put it in some simple math, I buy a rental property that brings in $2,000 a month in rent. What you're looking for this type of a loan is for all of my PD payments, taxes, mortgages, insurance, HOA, and whatever else standard payments that you have to be covered by that $2,000.
Correct. Sometimes we could do a negative DSCR ratio. I don't recommend it. It may trigger a rate increase. It may trigger an LTV or an extra down payment increase. I definitely don't recommend doing it. Negative DSCR ratio means that the rents are below what the PITI or the full expenses on the property are. That we can approve that sometimes, but of course it's going to come with a rate hit, meaning a higher interest rate, and or an LTV hit, meaning a higher down payment. LTV is loan to value.
So DSCR is a ratio, right? It's a ratio between your basically expenses and income for the property. Is there a certain number that you're looking for to get a loan approved?
So just traditionally, we're just looking for it to be even, right, for us to approve it. So we want the rents to cover the expenses, and that's it. If there's cash flow, even better. That makes you a lower risk. But on the basic plane, that's all we need to do is just cover the monthly payment. That's it.
Okay. So what are some common challenges that you've seen in the mortgage industry, and how have you addressed them?
Specific or just in general?
In general and specific to DSCR. Yeah.
So, I mean, if you want to talk DSCR, I mean, the biggest challenge is the rents are what you perceive the market rents to be as the consumer. They're not necessarily what the appraiser thinks, right? And it's always a constant back and forth, right? The realtor always thinks that the rents are higher, which they most of the time are what the realtor says and what the consumer says, meaning the home buyer. But the appraiser, they're just going to go off the MLS, right? They're going to pull your rental comps off the MLS. And of course, if your rental comps are lower than what you're using to qualify, you'll still get approved for the loan, but there might be a surprise for you where you need an additional, for example, 5% down, or just an additional down payment or a rate buy down to qualify for the loan. Because remember, DSCR, we're not looking at your personal income. We're not looking at your pay stubs, W-2s, or income tax returns. We should have just probably said that in the beginning. That's the whole basis of these loans, is that we're only looking at this one piece of property and its ability to sustain itself. So as long as you have qualifying credit, which is usually around 660 or higher, that'll usually get you into the loan if that's what the end goal is. But that challenge is always the rental comps, especially if the property is unoccupied or vacant, right? So if the property is vacant, we're looking at market rents.
That is interesting. So let's say I'm buying a property, and I think, again, back to our example, that the rent will be $2,000. My real estate agent tells me, oh, you can definitely rent it for $2,200.
Sure.
And then the appraiser goes in and he pulls the comps or whatever he does, and he says that the property market rent is $1,700. Mm-hmm. So what happens at that time, and why my real estate agent didn't tell me that? So,
and I could speak as a personal, I could speak as a homeowner in Philadelphia. Not every market is on MLS, or not. There are markets that I could specifically think of in Philly where you don't need the MLS to rent it. I just put property on Facebook area and don't rent or some version of that. And those comps don't necessarily get registered, I'm assuming. So it's a lot of times a back and forth with the appraiser and proving to them that the rents are what they are. It's not necessarily the realtor that's misleading. No one's trying to mislead anyone in all reality. But the appraisers just simply don't know sometimes. That's really the gist of it. They don't necessarily know the rental comps.
So there is a way to tell the appraiser that, hey, this is not actually correct. This is what the rent should be. Or once the appraisal report comes in, then you kind of lock to whatever they say.
So, but by definition, the appraisal report and the appraiser's report is an opinion of market value. So it's
Right.
just a matter of what his opinion, his or her opinion are, or is. I don't want to say that there's a way because every situation is different, and just as long as I find that as long as you're reasonable, most of the time there's a way to get the deal done. If one of the parties, including the appraiser, is being unreasonable, then that can derail your plans for the property. So just be careful is all I'm saying. Be conservative with your estimates.
Is it better than to buy already occupied property that has a lease in place? Then you will take the number from that lease and you actually know what is rented for, or it doesn't really matter for the mortgage purposes?
No, it's really a case by case. I mean, as a realtor, Yuri, that if you're buying an occupied property, there's got to be a reason why they're selling it. I mean, a lot of times the rents are going to be under market, which is not going to help you with the DSCR ratio. It just really case by case. It depends. It all comes down to the numbers and what you're purchasing the property for, and how and what your plans are with it. So you can't generalize it in my opinion. It just depends on the property. So some people want to buy it where it's under market and maybe stabilize the rents and that'll raise the value of it. So it just depends.
Yeah, that makes sense. Quick update. Our Jumpstart Northeast Philly program is live and we're accepting applications now. If you are in Northeast Philly and you're looking to learn how to find, buy, finance, fix, rehab, sell, or rent a property in Philadelphia, this program is built for you. It is based on proven success of Jumpstart Germantown program and focused on building local wealth while improving our own neighborhoods. You also will hear from multiple industry experts such as lenders, contractors, zoning experts, and more, sharing real practical knowledge to help you succeed. Don't wait, space is limited. The first program is running in September. The application process is open. To apply, click the link in the show notes or go to trustartrealty.com, select resources, Jumpstart Northeast. So what would you say specifically for Philly investors? When does it make sense to use DSCR loan versus regular conventional?
We see all types of folks. We see people that are, just have the means and just simply want to purchase an investment property as to invest in. I see people that, truly treat it as a business where they have a huge portfolio, and I see a lot of self-employed people come across my desk also where they don't necessarily have the tax returns or don't want to show them. That's one reason, is if you don't, for whatever reason, don't want to show us your tax returns. That's reason number one. Reason number two is probably even more important, is if you're coming into a transaction and you don't want to put it into your personal name, a conventional loan is just simply not for you. If you were trying to put it in a corporate name or an LLC name, then you need to look into a DSCR option. That's really the main reason, the main vehicle for taking a loan like this.
Okay, so another piece of information, I guess that's important here. If you want to buy a property under an LLC or whatever business structure that you may have, you will not be able to qualify for regular conventional loan.
Yeah, conventional loan is going to require that you put it into your personal name, and that a lot of times is a non-starter for a lot of investors. I mean, from a tax purpose and a liability purpose, it's just not always the way to go.
So if we're talking about this difference between conventional and DSCR, right? And one of the most important ones here, at least in my mind, is personal name versus LLC. A lot of people want to put it in LLC, and then they find that problematic that they cannot find financing, or it's a little bit harder for them to find financing. And from what you're saying right now, it sounds like it's easier actually if you do DSCR versus conventional. Can you?
Yes, it's definitely easier. Again, if the deal makes sense, if everyone is reasonable inside the transaction, right? And when I say reasonable, I'm talking about numbers. They have to make sense. If the property can't carry itself, then maybe a conventional loan is for you, right? But at the same time, why are you buying it? I mean, there may be a million and one reasons why you're buying an investment property that doesn't cash flow. But in this particular case, the investor or us, the lender, the bank, whatever, again, there's different names for what you want to call us. we look for the property to cash flow, or at least cover itself, and that's really why we underwrite that way. As far as an LLC is concerned, yeah, it's less liability, and definitely there are definitely some tax breaks to it.
Before we continue, I would like to take a quick moment to thank our sponsor, Trust Art Realty, full-service property management company in Philadelphia. If you're a landlord in Philly, you know that managing rentals can be complicated. That's why Trust Art Realty is offering all of our listeners a free rental analysis or management advice session. Whether you need help understanding market trends or improving how you manage your rentals, they've got you covered. To claim your free analysis, shoot us an email to truststrealty@phillylandlordguy.com or click the link in the show notes and somebody will get in touch with you. Now let's get back to it. Okay. Are there any specific type of properties, specifically in Philly, that are better suited for DSCR loans?
Good question. So I would generalize this. I would say all over, but the one thing you have in Philly, if you want to talk about Philly specific, you have a pretty hefty transfer tax. I'm not saying that this is proper or is something that you would want to do, but I've seen people do this where they just simply sell off their LLC or corporation, right? Somewhere down the road, years from now, to avoid the transfer tax. So that's one thing that stands out. You don't really see that anywhere else outside of Philly. Aside from that, it's really a 1 to 4 unit world, meaning that if you're purchasing a residential property that's 1 to 4 units, they're rather simple or to finance versus a mixed use or commercial property, because you can do DSCR on any type of property. But anything that's 1 to 4 units is generally more marketable and easier to finance.
Okay, so anything that is 5 units plus, that would be considered as a commercial property, is that right?
Correct. Yeah, or mixed use. You could have a 2-unit mixed use. But anything you get into mixed use or commercial, it gets just a little bit more difficult. And when I say difficult, the loan to value requirements and interest rates are going to be different.
Yeah, and mixed use is when you have one commercial, like let's say the most common here is you have a storefront somewhere in the main street, and then you have an apartment above it. There you go. That's your mixed use, and now all of a sudden you're commercial, and you cannot even go and get a regular loan for that. But another point that you just mentioned is that people sell LLCs instead of the actual property. So when that happens, so let's say I have an LLC, Main Street LLC, and I own 5 properties in that LLC. So now I decided to sell instead of properties, I'm selling my LLC. So we avoid transfer tax. How would I finance a deal like that?
Great question, Yuri. So you would need proof that you own the LLC first and foremost. So if you're coming to me and you present, usually we look for an operating agreement to show who the members are. And, if you're more than 10% owner of the entity, you become, we essentially, you become a personal guarantor most of the time. They do require a personal guarantee. We should mention that. So if you're financing it under an entity name, the first thing we're going to look at is you. We're still going to ask for your social security number. We're still going to ask for your personal credit to make sure that your credit is viable. So as long as you present an operating agreement showing that you're more than 10% owner, we're going to consider your personal, not income, but definitely personal credit to qualify.
So it doesn't essentially it doesn't matter if I buy a property by itself or I buy LLC that owns properties. It's the same process or different.
You can't just buy an LLC. I mean, I would imagine that I would imagine that you can't just finance an LLC. Is the straight answer? You can finance you can finance the properties that are in the LLC umbrella or just a single property. But you definitely can't just finance on the LLC itself. You need collateral behind it. Did I understand your question correctly?
I understand what you're saying, but I'm trying to get an idea of how exactly that would work. So again, let's say let's make it easier. You have a property in LLC. I want to buy that LLC. It's in Philadelphia, so we want to avoid transfer taxes. So you sell LLC to me instead of selling the property itself. It's by buying that LLC.
You can't finance. You can't finance LLC. It's
Okay.
impossible.
So basically, all of those deals are cash deals or some kind of
usually cash deals. Yeah, not something that I'm usually involved in. Never, to be honest with you.
Okay, so it's either cash or some kind of creative financing, but
creating financing that I will not be a part of.
Okay, makes sense.
I've just heard over the years that some people do it, and that's probably something that's very unique to the city. The old owner would stay back and maybe, as per agreement, hold on a very small percentage of the LLC. That's usually how it's done. So you could, in theory, refinance. So if you present operating docs and we just look at the percentage of ownership, I guess that's a way to approach.
Yeah.
It would be more of a refinance than anything else.
So you definitely need to get more creative to do it that way. So then let's step back to our DSCR. And what is the difference between conventional and DSCR in terms of interest rate and terms for the loans themselves?
So when it comes to mortgages, everything is down payment and credit score driven like anywhere else, right? But I would say, just as an example, you're with a down payment of 20 to 25% down, with credit score over 700, you're probably hovering anywhere from a 0.5 to 0.75 interest rate difference, meaning DSCR would be more expensive versus conventional. Another thing that DSCR a lot of times carries, I don't want to say every time, but a lot of times it's going to carry a prepayment penalty, which sounds like, to me, like a red flag when I say prepayment penalty. But what it really does is to the bank or the investor, it's going to guarantee a certain amount of years of you keeping the loan. Hence, they give you an interest rate reduction for that prepaid penalty. So it's not, if you're keeping the property long term, it's definitely something to consider, taking a prepaid penalty, and it helps keep the interest rates lower. That's all.
What about the term of the loan? Is it the same? Is it like 30 years fully amortized, or?
Usually, most of the time, fully amortized, and most of the time, 30-year. Because once you cut the term back, you're raising your monthly expenses, and you're just going to qualify for less mortgage or less loan amount.
Okay, so you mentioned that whenever I apply for DSCR loan, that you will not request my tax returns and any personal stuff, but will I still have to personally guarantee the loan?
Absolutely. Yeah, we said that earlier. 99% of the time, you're personally guaranteeing these loans because they're smaller balance. There are what we call non-recourse loans on the higher balance. To be honest, not something that I'm a part of. It's not something that I offer on my end. So all of the loans that we offer in our company are going to be recourse, meaning they're personally guaranteed.
Okay. And just to, I guess, to let everybody know, if they don't know what that means, what does it mean, personally guaranteed loan?
Stop paying the loan, you still owe the money. So it's just the basis of any mortgage is if you stop paying the loan, obviously the bank has a right to foreclose, and you're also personally responsible. So in this case, if you're buying it under an entity like a corporation or LLC, the entity is responsible, but you are responsible for it as well. One added thing that we didn't discuss is that most of the time, if you're financing in a corporate name, the loan is not going to appear on your credit report. That's a big one that a lot of people don't realize. So you'll have the mortgage, you'll have the property, but because you don't own it personally, it's not going to show up on your personal credit report. That's another feature that a lot of people don't realize.
Until you stop paying on that mortgage.
Well, if you stop paying it, the payment history also wouldn't show up. In theory, again, there's exceptions to everything that we're talking about.
Yeah.
But in theory, yeah, and if you stop paying, nothing good will come out of it. That's the answer.
Right. So basically what I was trying to get into, if I have an LLC and I get a property under LLC with DSCR loan, and even if it doesn't show up on my personal credit report, if I stop paying, I am personally still responsible. It's not just the LLC that
Yeah, if the property gets sold in auction, whatever the deficiency judgment is, it's going to get attached to your name. Is the real answer.
Yeah, so the process would be the same as
Yeah.
if you own the property.
Yeah, and if you want to talk about foreclosure, fairness theory, it would be like another hour
Yeah.
podcast.
So, what are the typical down payment and reserve requirements for DSCR loans?
So, down payment's easy. It usually starts at 20% plus, meaning more, and that gets determined by the type of property and determined by the credit. But most of all, the DSCR or debt service coverage ratio, right? So if 20% is not enough to cover the monthly mortgage payment, we're just going to require more down payment until you get to that level. Sometimes it may be cheaper to buy down the rate versus putting more money down, and it's just, again, every case is individual. So when you talk about reserves in the mortgage world, we're referring to how many months of payments, and payments are principal, interest, taxes, and insurance. And the real answer is, depending on the type of property and your personal qualifications, anywhere from 0, meaning no reserves, to as much as 6 months reserves in the bank, meaning that's how much money you have left over, verified after you've purchased the property, down payment and closing costs.
Who determines the amount of the reserves?
The investor, the guidelines. And it's something that's predetermined when you apply.
Okay. So can you walk us through the underwriting process for DSCR?
Sure. So obviously, application is step one. If we're applying for a DSCR loan, we're not verifying your personal income, so that portion of the application is blank. We don't fill it in. Credit, we do a credit check. We do a full application minus the income. So all of your properties, real estate owned, and so on and so forth, all the standard things or items that go in there. We do verify your assets. We need to make sure that you have enough money to purchase the property, which again includes down payment, closing costs, and reserves if required. And then the next big one, of course, is the appraisal itself. That's usually the biggest qualifiers. The appraisal, we look at the collateral a lot more closely, meaning that, again, the rental comps, its marketability, and so on and so forth.
As far as the money to purchase the property go, is there any requirement for it to be seasoned, or I can show you like, hey, I have my HELOC and this is what I'm going to.
So you can use a HELOC to purchase it. That's no problem, especially on the DSCR loan. We just want to see where the money's coming from most of the time. There are different. Again, there's a spin on every different type of program in the mortgage world, where you need to have the money seasoned for at least 2 months, for example, or no seasoning required. It's all going to come down to what you have and what you can qualify for. So some folks, they'll have the money come in like the day before closing, and that's okay. For others, they just have the money and they could show it. It's not a problem. Usually, the more you can provide up front with any mortgage application, DSCR included, the easier the process is, but the better off your terms are, right? So the paperwork is king in our business. So the more paperwork you can show us, the more seasoning you can show of funds, the easier your process will go, and of course, the better terms you'll get. So it's going to come down to, are you willing to pay a higher interest rate for no seasoning on your bank statements? And if the answer is yes, then it's okay. And when I say higher, it could be a very slight difference.
Makes sense. Okay, can you tell us what documentations needed to qualify for DSCR loan?
Actually, good question. Again, bank statements, picture ID. We usually look for a driver's license. If you have an immigration status, if you're not a U.S. citizen, we'd like to know what your status is. We have to know, actually. You do have to be here, legally. So we're going to document your immigration status almost every time. And we can do DSCR loans, just so you know, even for foreign nationals. But as an example, if you're a foreign national, meaning if you don't live in the United States, you do require a business visa. So you need to have some sort of proof that you can come into the country legally. So immigration status, picture ID, bank statements showing enough funds to qualify or to close, and that's just about it. If you own any other real estate in this country, we would need to document it, usually either with a mortgage statement and or tax and insurance bill, if they're fully clear.
Okay, that's actually interesting about the international investors. So as long as you have a visa to enter the country, you say that you can still apply for DSCR loan.
Correct. Yeah, you can legitimately purchase a property in an entity name, meaning corporation or LLC, in the United States, as long as you can come into the country legally and as long as the funds are in a U.S. account prior to closing. And that's going to require a higher down payment. It's not 20% down. It's usually
can you talk a little bit more about that? Because I'm sure
Sure.
a lot of people would be interested. I am interested just to know what it looks
Yeah,
like.
we get this request all the time. And we get people that want to purchase a property in the U.S. They, again, it's still the same DSCR loan. We're still looking at the asset, right? The collateral. But there's no credit check.
Right.
No fairness, you're not going to have U.S. credit. You're not a U.S. resident. There's no social security number to provide because you don't have one. You just need to form an entity. Most investors, I find over the years that most experienced investors, they usually form an LLC or an entity for each property they're purchasing. They usually don't put it into an umbrella. Throughout the process, you don't need to have the entity formed prior to the contract or prior to application. We usually end up forming it midstream somewhere. That's it. And most of the time require that you're here for signature. Sometimes you could do a power of attorney, but I wouldn't bank on it. So you want to come here for settlement. And
what the down payment would look like for clients like that?
I would say at minimum 25 to 30% down payment. Expect longer closing times also. This is not something you close in 30 days. Definitely not a foreign national deal. You're probably looking at more like 45 plus days to close. Regular traditional DSCR 30 days is very doable, but if you're foreign national specifically, it can take a little bit longer. That's all.
Okay. And as far as the interest goes, is it going to be similar to what you offer to regular people, or?
Well, they're all regular people to me. Yuri, but
I mean,
it's a higher risk. Yeah. So in the mortgage world, the higher risk, the higher the interest rate. So foreign national, there's no credit check. There's nothing, or the rate's going to be about 1% higher over a standard DSCR. That's my estimation. And this is something that is ever evolving. Just interest rates. It's impossible to predict what they're going to be in the next hour. More so to predict what they are right now. It just depends.
Okay.
Another topic that can fall under the DSCR umbrella, Yuri, that a lot of people are not talking about is you can use, if you're looking for, this is probably more for a primary residence, but you can do this with an investment property as well. If you're looking for the best possible interest rate and you're self-employed and don't want to show your tax returns or can't for whatever reason, a lot of times we can use your bank statements as cash flow, right? So we can use your cash flow from your business, from your bank statements, and based on that cash flow, we qualify you for a mortgage. And to me, this is all one part of one big umbrella of programs.
So what? It's not a DSCR; it's something else.
No, correct. Yeah. So if it's for self-employed. If you're self-employed and doing in whatever business it is that you operate in, we can take your business deposits, for example, the past year, 12 months, and qualify you for a mortgage. So essentially, we're just taking the top line deposits and averaging them over 12 months, and that's what your income becomes on your loan application.
Why would you choose that instead of DSCR?
If you're after a lower payment, or if you're purchasing a primary home, for example, a little bit of a tangent, but similar, you could put less money down. The less money down piece is for a primary. If you're trying to do less than 20%, if you're trying to stay right at the 20% mark and want to avoid the DSCR ratio, bank statements may be a way to go.
Okay. What would you say? How does the current Philly rental market impacts the DSCR loans?
It's for me, Philly is such a diverse, rental market. It just depends on what part of town you're talking about.
Yeah, there are so many areas.
Yeah, there's so many areas, and just there's maybe a small area that I'm intimately, familiar with. It just depends, man. It's just all, again, it's all going to come down to the rental comps. It's not, you can't just, in my mind, you can't just generalize the whole city. If the comps are there, if it's cash flowing for you, it makes sense. If it makes sense, we'll approve it. That's really what it comes down to.
So where would you suggest people to start? So let's say I'm looking to buy a property. I do not know. I've never done DSCR loan yet. I want to do it. Let's say this is my second property and I heard that I want to put it in LLC. I want to do DSCR. Where do I start? Do I go to you first, or do I go to my real estate agent, or do I go to my property manager? Where should I start?
I find over the years like I told you before, a few minutes ago, mortgages are very dry, so it's so hard to put a number on something that you haven't seen yet or don't know, what it can do for you. With real estate, to me, it's such a personal thing. I like to be close by. I like to be able to come look at it and understand the neighborhood. I would say it's a team effort, Yuri. I mean, ultimately, that's usually what I find to be true. I mean, I've seen realtors, come in with their clients into my office or be on a Zoom conversation or a three-way phone call. But I would say it's definitely a team effort, because you can't just put numbers on something that you're not familiar with. And most of the time, the realtor knows the neighborhood and knows the properties, and it's just a team effort. It really is. Let's say call both of us.
Right. So what do you think? Can DSCR loans, or not think, I guess, what would you say? Can DSCR loans be used for property renovations, or are they only for the purchases?
So the premise of these loans is that they're all permanent loans. They're all assuming that the property is in livable condition. So if the property becomes, if it's not inhabitable and needs money for renovation, usually buying it at a discount, but definitely not under this umbrella of products. It's usually more for a fix and flip or a renovation loan, which a lot of times you can convert them at the end to a DSCR loan or a permanent loan. But by definition, investment property renovation loans, fix and flip loans are usually temporary loans, unless you're doing it for investment property. Excuse me, primary residence.
So if I'm looking to buy a property with DSCR loan, the property has to be in living conditions.
Livable, yeah. Like, for
Livable.
example, you can't have any bare floors, like can't have plywood, can't have wires sticking out of the ceiling, can't have, water, from the roof going inside the house. There's a million and one reasons why something would become unlivable, but it just has to be intact.
Is there any kind of checklist that you may have? What makes property livable, or what is livable condition? Because
give you general guidelines. Yeah, that's always an art. Also, just like anything else in the real estate business, generally it just has to look like it's intact. You don't necessarily need the utilities to be on, but the property, it can be old and maybe even at times dirty, but it has to be intact. You can't have any like studs hanging, can't have any like studs without drywall, unpainted walls, for example, uncovered flooring. I mean, the list goes on and on. I mean, the best answer I can give you, Yuri, is if you have a property, or if any of your clients have a property that is questionable, I would say maybe do a FaceTime with me. We'll walk through the property together, or shoot me a video or some pictures of what your areas of concern are, and I can give you an answer. And again, this differs from investor to investor, right? From bank to bank. So what one bank may think is livable, another one may say, oh, no way, we're not touching this. For example, I had one the other month where the property was fully renovated and was good to go, but next door was a board up. It was actually a Philly property. A board up meaning, there was plywood on the windows.
Mm-hmm.
And the underwriter looked at it and said, no way, right? So
why not?
Just not a desirable, block for them. They didn't want it altogether. They just denied the loan just based on the next door property, which wasn't even our collateral. We got the deal done anyway, right? But that's just how it goes sometimes. It just really opinion-based underwriting for DSCR, and sometimes a property that where one underwriter would want it, another one won't. So
do you see that happen often in Philly?
Not as often as you would think, but it's something to be aware of. It's definitely something. It can impact the marketability of your property. If
right.
You have abandoned property next door, it's going to potentially impact your marketability.
Yeah, it makes sense. If you sell that property and you have a vacant property next door, you will have less people who would be willing to purchase it. But still, it's an interesting.
It's just something to consider. I'm not saying no way. I mean, we got the deal done. It's not that, but it's not necessarily it wasn't necessarily a smooth transaction as I like to call my transactions. We want everything to be smooth. Everyone wants to live in a.
Yeah. So, but going back to the original question, that how do you determine if the property is livable? So basically, as long it doesn't have to be beautiful, it doesn't have to be brand new. You don't have to have granite countertops or anything like that. As long as the property doesn't, it's not falling apart. You don't have like exposed studs, or you don't have exposed ceilings, wires, walls, floors. Basically, if everything is intact and you kind of can move somebody in, then it would be considered most likely as a livable property.
Correct. Yeah, that's the general guideline.
Okay, makes sense. And Leon, what would you tell to a person, or what kind of advice would you give to a first-time buyer considering getting a DSCR loan?
Always put it in the entity name, right? Create an entity for every property you're buying. I wouldn't just plop everything under one entity, corporation or LLC, and do the math. Make sure you understand the math, the cash flow, the expenses associated with, operating the property, acquiring it, and so on and so forth. So what a lot of people do is they buy on emotion, right? That's probably, I'm sure you'll agree with me, Yuri. It's probably okay to buy a primary home on emotion and get excited about it and say, this is the one I want. And it's okay if I pay a little extra. It's okay as long as I can afford it. I'm buying it. This is more of an investment piece, and it's got to make sense financially. It really does. It has to work for you, not the other way around.
Yeah, that's actually a good point. That's exactly the reason why I never work or like working with clients who's buying the primary residence, because it's emotional purchase. And for me, if something doesn't make sense, it doesn't make sense.
Yeah, it's a necessity and it's an emotional. Whereas this is more of I have a place to live. This is just an investment, and it's got to make sense. It has to be financially sound, and buying it in a hurry, in a rush, or even. And I've made these mistakes on my own on a personal level, where somebody wants to sell it fast, and that becomes a condition of the deal, and then you don't put it into an LLC or don't use a DSCR loan, and that's not necessarily a good thing, right? That's just one small. It sounds simple, but it's really not. Down the years, it's going to catch up to you. So just make sure it makes sense, because buying it is one thing, but God forbid selling it right afterwards or in a short time frame. You don't want to do that. You want most investors, I find, are buying it for the long haul. They're buying it to realize their investment down the years, or to hold on to it for generations to come. So it's got to be a sound decision.
So you mentioned that you would advise someone on getting different LLC for every property they buy. What is the reason behind that?
I'm sure I could come up with a whole list, but just off the top of my head. So from a liability standpoint, again, I'm not trying to be doom and gloom today, but God forbid, the classic case is the tenant, walks outside of the property, slips and falls. They're going to find the entity or the owner of that property liable. So if that LLC owns, for example, 7 properties, then everything is tied up, potentially in a lawsuit, God forbid, If you want to transfer the LLC to someone else, it gets much easier if it's a separate entity for every property, and the list goes on and on.
Okay, so Leon, is there something that I didn't ask you about, but there is a very important piece of this conversation about DSCR loans that we missed?
I think we pretty much covered everything. Again, like you said, mortgages are such a dry topic unless you're in the process yourself. Then it becomes so intricate. For you, you've been around this a very long time, so it just all comes naturally to the first-time investors. Some of this may sound like a different language, which it really is. I would say reach out to us, reach out to you, reach out to me, whoever you're more comfortable with, to understand it. But you just really need to understand the numbers. That's what a lot of folks, I find, especially on the commercial side, a lot of folks are diving into properties where they don't understand the investment required to acquire it, and that's probably what kills the deals most of the time. Like the ones that don't close, we call them dead deals. Not a topic that I like to talk about, but just you have to understand what you're buying and the again, the cash flow and the cash outlay associated with it. That's really the biggest advice. Is do the math. So This way you're getting into something that you understand.
Okay. So if somebody wants to reach out to you, what would be the best way to do it?
So my phone number, the main office line, 267-309-2700. I would say call or text is probably the best way. You can, of course, email always. But if you just want to get me on the phone, just pick up and call or text. And I would say in person. That's another thing. I like to do things in person. That's probably one thing that makes me unique, or that's what people say. Meet in person and go through the numbers. That a lot of times is what sets the transaction off.
Okay, sounds good. Well, Leon, thank you so much for all of this information.
Yeah.
Hopefully that helps somebody out there trying to figure out what is DSCR loan and how to use it and where you can get it.
100%. Always a pleasure, Yuri.
Okay, thank you for being with us.
Thank you.
Bye. That's a wrap for today's episode of the Philly Landlord Guy. Big thanks to Leon Belov for breaking down the financing game and giving us straight answers on DSCR versus conventional loan. If you got value from this, make sure to subscribe, leave a review, and share with another Philly investor who needs to hear this. Until next time, thank you for watching.